opportunity for you guys. But in the meantime, and I believe that we have two separate chats. I think that we have a chat box and a Q&A box. So for anything, I could be wrong, but I believe that we do. But for anything like logistics related or anything like that, like you can't hear me or any other sort of like technical issues, put that in the chat box and we'll try to get it fixed. But I believe there should be a Q&A box to where you can go ahead and put your questions in as the webinar goes on. And then at the end, I will be happy to answer them. And also, too, just a reminder that a recording of this webinar will be sent out 24 hours after this event. So if you miss it or have to leave early, don't worry, it will be sent out. And if you have any questions about this, please feel free to email us at webinars@collective.com. And also, if you wouldn't mind, share on your social media pages that you're in this webinar, because a lot of, self-employed people have people in their network that could benefit for these kind of services. So if you wouldn't mind, we'd really appreciate that. But at this point, I think we've got enough people in the webinar. We should go ahead and get started. So just to kind of recap the agenda, we're going to talk about taxes, specifically the taxes you face when you have your own business, when you're self-employed. And then we're going to discuss S Corps, which, at a certain point, it's just kind of the next step for a lot of business owners once they reach a certain point in their business. So we'll discuss that. And then we'll discuss how to estimate your taxes, how to do that in the first place. And then we'll talk a little bit about collective, and how we make the process easy to where you can focus on your business. Quick word about collective. We're the first all-in-one back office platform. So essentially, we take a tech-based approach and a consultative-based approach. We essentially mix technology with professionals to make you have a really good experience, not only a convenient experience, but a professional one as well. And kind of one of the reasons, or several reasons, why collective is so valuable is because there's so many things to juggle when you're self-employed. Not only do you own a business and you have to literally run the business and make your money, but there's a lot of compliance issues that you got to deal with too. You've got to estimate your taxes. That's not as straightforward as it sounds. You've got to determine what is and what isn't, business deductions. What can I write off? When you're self-employed, you could get a huge surprise tax bill at the end of the year. I see that all the time. So, there's just several challenges that you can face when you have your own business. And how do you feel when you're trying to figure all this stuff out? um, most of the time, you feel pretty stressed. That's in with my job as a business advisor here at Collective, it's my job to speak, to prospective Collective members to see if we'd be a good fit for them. And one of the biggest things that I hear about it is, peace of mind. What people are looking for is just to know that things are being handled, that they have a partner to navigate, these serious compliance issues. And that's where Collective comes in. What stresses you out the most when it comes to taxes? All right, and I believe this is a poll question. So we'll have some polls that you guys can answer throughout the presentation, and I think this is one of them, unless I'm mistaken. Yes, it is. So what are you struggling with most right now? And honestly, I get a different answer every time or a different answer to this question every time I ask this question. So I'm curious to see what it will end up in. I'm going to guess either setting up your LLC or S Corp or bookkeeping. We'll see if I'm right. All righty. I was wrong. I was really wrong. Okay, so it's a tie between taxes and finding ongoing financial advice. Okay, well, hopefully I can at least make the tax part of things more illuminated by the end of this presentation. All right. So tax planning, like the basics in tax planning is, what taxes are you subject to and what tax structure is right for you? That is kind of the fundamental questions you ask when you're thinking about tax planning. And here is how taxes work when you're self-employed. One, you've got income taxes. That's what most people think of when they hear the word taxes. Um, Income taxes are marginal tax rates. It's a marginal rate, meaning that you pay in brackets. So, a chunk of your income might be subject to a 10% tax rate. The next chunk of income, might be subject to a 15% tax rate. So it just kind of depends. The self-employment tax, though, is a flat tax rate. It's a flat tax rate of 15.3%. And literally what that 15.3% is Social Security and Medicare taxes. What these taxes are. When you're an employee, you still pay these taxes. You still technically pay the self-employment tax when you work for someone else as an employee. But the difference is half of these taxes, they're paid by your employer, and half of them are paid by you. But when you're self-employed, you pay both halves. You're subject to the full 15.3%. That's what that right there is why self-employed taxes can be so expensive. It's because, you have, a full responsibility for the Social Security and Medicare taxes. When you're an employee, you only pay half. When you're self-employed, you pay the entire thing. And this example has to do, I want to say, this person is making around $100,000 net income. And when they're an employee, their check is around 100 grand. They're only paying 7,500 in the Social Security and Medicare tax. But when you're self-employed, you're paying the full 15,000. So how it works, of course, is you have your total revenue, which is just your total gross income, all the money that you make. Then you have your deductions, which are your business expenses and things that you can write off from your income. That gives you your net income. And your net income can either be positive, which means it's a profit, of course, or it can be negative, which means that you have a loss technically. And what happens is all of this is reported to on your personal tax return. And either the profit or the loss, it doesn't matter. And the profit is subject to both the self-employment tax and the income tax. What's an S Corp? That's one of the main reasons why we're here, right? We're trying to answer that question. Before we kind of get into S Corps, let's talk about legal structures. So when I say a legal structure, essentially what I'm talking about is a business entity. A business entity, it's entities you form with your state, with the Secretary of State, typically wherever you live. Um, Entities like LLCs, corporations, excuse me. Entities are generally required to file, some sort of a report every year. It essentially let the state know that it's still in existence, that it indicates to the state who owns the LLC, who manages the entity. This isn't a tax return. It's an informational form that you file with the state on information about your LLC or corporation. And again, this is usually done, the formation, setting up the LLC or the corporation or, whatever business entity you're setting up with, and the informational documents that you got to file are usually done with the Secretary of State's office. That is usually in the state context, a totally different group from the taxing authority. An S Corp is not a legal structure. Like it's not a business entity. It's a tax election. It's a way to ask the IRS how to tax your business. And a lot of people think that an S Corp is necessarily a corporation, but it's not. It's a tax structure. So the IRS just automatically assigns a certain tax structure or a tax treatment based on, what kind of entity you are. If you're, a single member LLC, if you just have that set up, you're automatically taxed the same way as a sole proprietorship is. But when you make an S Corp election, you're asking the IRS to tax your LLC a little bit differently than it would be if you were just an LLC without an S Corp election. And why are they great? Like, what exactly do they do? Long story short, S Corp owners, they don't pay self-employment tax, the 15.3% on the business profit. So essentially what that means is S Corps, you're allowed to pay yourself a salary. You essentially become an employee of your own business. And like your entity employs you as a W-2 employee. And the sort of advantageous thing about it is the self-employment tax is now only subject to the salary that you pay yourself. The rest is the business profit technically, and it's no longer subject to the self-employment tax. But there is a catch. The IRS requires that you pay yourself a reasonable compensation. So whatever salary that you pay yourself, it has to be reasonable. And a lot of people will ask me, well, if I'm only subject to the self-employment tax on my salary, then why not just pay myself a super low salary and take out most of my profits in business profits or distributions. And it has the potential to increase your risk for audit if you pay yourself too low. It's got to be reasonable compensation. But you only pay the self-employment tax on your W-2 wages. And this is kind of how it works. It's just kind of like a visualization of how the finances with an S Corp work. You've got your total revenue, essentially your net income here at the top. And your salary comes out of that net income. And that salary portion is subject to the self-employment tax, which is just another word for payroll taxes. It's the same thing. And then you have your expenses, meaning business. Excuse me, let me back up. I made a mistake. So that top line is actually your gross income. Apologies about that. So that's your total S Corp revenue. And out of that gross income comes your salary that you pay yourself that is subject to the self-employment tax. And you have business expenses, which, of course, you can write off. And then, of course, you have an S Corp profit or loss. The S Corp either, makes money or doesn't. And that profit or loss, ends up on the owner's personal tax return. So here is just kind of an example as to how you save money with an S Corp. Let's assume that this first person is making around $160,000. Let's assume that. And let's also assume that this person is a sole proprietorship, meaning that you can't, really pay yourself W-2 wages. So that means that all of your income or all of the net income is subject to the self-employment tax, 15.3%. So, which comes out to a pretty hefty tax bill at $24,000. However, let's assume that someone has made an S Corp election on that LLC. And let's assume that they make the same amount of money. Let's assume that the income is $160,000. But with an S Corp, you can pay yourself a salary. And in this scenario, this person has decided that $60,000 for whatever reason is a reasonable salary for them. So now only that $60,000 is subject to the self-employment tax. So that drops your tax bill, the self-employment tax bill, from $24,000 down to $9,000, which obviously is a pretty substantial difference. And right here, the $100,000 is the pass-through profit. Another word for them are distributions that you give yourself. But that chunk of money is no longer subject to the self-employment tax. So, the difference, you save $15,300 in the self-employment tax, which makes sense, right? Because all you got to do to, calculate your tax savings is you take $100,000 and you multiply it by 15.3%, the self-employment tax. And that's the, amount of money that you aren't going to pay now that you're an S Corp, which can be pretty substantial. It's a small business owner's best friend. So essentially what it does, it recognizes that not all the profit, like not all of the income that your business makes is from your active work. Some of that value and the money you're making and essentially the return that you're making on your business is because of just building your business and making it more efficient. And it also recognizes that not everyone needs a large suite of corporate owners. So, two layers of, regular C Corp taxation isn't necessary. So that's kind of the idea behind the S Corp. Which one's best for you? Should you just stop at the LLC stage, or should you have an LLC with an S Corp election? And typically, LLCs are best for people who are brand new to business and aren't sure how much they're going to make. They've got very little earnings and they don't have, very many projections on their income. But and also typically they earn less in the $60,000 net income per year. Uh, Usually for situations like that, kind of like a simple, straightforward tax situation is usually the best. S corps, however, they're usually the best for people that earn a little bit more. One that earn more than $60,000 in net income per year. Wants to maximize retirement. There's some advantageous strategies you can put into place when you're self-employed with retirement. And if you have enough money in flowing through the business to meet your payroll runs, for your own payroll. All right, well, getting a salary is great. Paying myself is fantastic. But how much do I pay myself? Let's discuss, how that works. Like I mentioned earlier, your salary has to be reasonable. And unfortunately, there's no sort of objective measure or, set standard for reasonable compensation. It's a facts and circumstance test, based on your own situation. And generally, and we kind of call this, and certain professional calls this the smell test. It's generally accepted that between 35 and 45% of business profits, and sometimes I see 30% and 50%, it passes the smell test of reasonable compensation. However, it's not a set objective. Like you very well could be paying yourself 35% of your business profit in salary, and it could not be, it very well could be unreasonable in the IRS. So it's just kind of a rule of thumb. It's not objective. But essentially what you got to do is come up with a method to justify what you're paying yourself in salary. And your tax professional can help you do this. Let's talk estimated taxes. Because when you're a self-employed owner, you've got to estimate and pay your own taxes because there's no employer rather, taking money out of your check. So essentially, you should pay estimated taxes if you think that you can owe $1,000 or more in tax. And if you're an independent contractor, if you're 1099, essentially, if you have your own business, if you're a sole prop, doesn't matter. Like all of those people usually need to make estimated tax deposits. Why do I even have to pay estimated tax deposits? Well, it's because the IRS wants you to pay taxes as you earn the income. A lot of people think that taxes are paid at the end of the year, but they're not. They're supposed to be paid throughout the year. And if you have a W-2 job, like just working for someone else, they probably are paid throughout the year through, payroll deductions and deductions out of your paycheck. Again, like I mentioned earlier, you're supposed to make estimated payments if you expect to owe $1,000 or more. If you don't have enough tax through withholding, through a job or, through your quarterly tax deposits, they could charge you a penalty. You might even be charged a penalty if your estimated tax deposits are late, even if you're due a refund, even if you don't technically owe tax and you paid all of your tax throughout the year or do a refund, you might still owe a penalty if you don't pay them on time. Estimated taxes, they're due every quarter. So they're due the month after the 15th, halfway through the month after every quarter. So of course, that'd be April, June, and September. And of course, it's January 15th because December is the last month. And your last estimated tax deposit is due in the first month of the next year. So, for 2024, your last estimated tax deposit would be due on January 15th, 2025. All right, let's get down to business. How do you even estimate your federal taxes? There's this fun little trick called the safe harbor rules. And essentially, you have two options and you pay the lesser of these options. For one, if you pay at least 90% of your current year's taxes through estimated tax deposits, then you generally do not get penalized. So, for example, if you think that you'll owe $1,000 in taxes, you need to pay yourself a quarter of that each quarter to avoid a penalty. Or you can pay 100% of last year's taxes, even if last year's taxes is a little bit less than what you'll pay this year. So, for example, if you owe $2,000 in taxes last year, you'd pay at least a quarter of those every quarter. All right. This is, you can also pay, you can do your actual numbers too. You can do actual estimations. And essentially, what you got to do is you estimate your adjusted gross income. You know, this is all the income that you make, like your gross income minus your business expenses. And, you know, with some people that kind of have consistent contracts and kind of get paid, you know, pretty consistently every month, this might be a little bit easier for them to do because it it's just it's easier to um, I guess like see the future when your payments are more structured. But when you're all over the place, this might be a little bit more complicated. So it just kind of depends on where you are. Then, of course, you take taxes into account. You multiply your AGI, your total income, by your applicable tax rates. You know, you can do that by going online, looking up the tax rates. And then, of course, you got your estimated tax payment for the entire year. And all you got to do was once you estimate your taxes, you divide that by 4, and that's how much you should be paying each quarter. Estimated taxes are not just for the feds. You know, a lot of states have them too, especially states that charge income taxes. Yeah, for example, here's one in California. If you expect to owe at least $500 or $250 if you're married, you got to pay estimated taxes. And you can see the calculations right there. But yeah, just keep in mind that states can also require you to pay estimated taxes. What happens if you don't pay estimated taxes? Well, if you um, are a sole proprietorship, you have zero withholding. They're a W-2. You don't have any sort of paychecks that are taking money out of your paychecks automatically. So you've got to estimate the amount of income that you make and pay estimates on that. When you're an S Corp, you pay yourself literally a paycheck, you know, through a payroll processor typically. And you can increase your W-2 withholdings to, you know, take care of your taxes. And if you have enough withheld in your withholdings, then you don't have to worry about estimated tax deposits. What can you do now to make your 2024 tax payments lower, your estimated tax deposits? One is you should consider an S Corp if you're, you know, on a certain income level. And what it does is it maximizes your take-home pay. When you, of course, do an S Corp, you say less in the self-employment tax. And by the way, with our collective members, they save an average of $10,000. So just kind of theoretically think about it. Take then $10,000 off your estimated tax deposits, and that could be pretty substantial. And essentially, with an S corp, you know, it's fun to save all these extra taxes, but there are some additional administrative requirements that are involved, as we just went through. And with collective, you don't have to deal with this ever again. We'll take care of it. And like I just said, it's more complex to run an S corp. So, you know, it's usually not a good idea to do it yourself. The first thing you do, of course, is you got to form an S corp. And the first step you got to take is usually getting an LLC set up if you don't have one already. Obtaining an EIN number from the IRS, making the S corp election with the IRS, and registering your payroll account. And then you've got to maintain it. The state, you know, since you're an employee, there's usually state forms that you got to file. You've got to come up with your own reasonable salary calculation. You need a payroll software. You've got to handle your own quarterlies. You've got extra tax returns. And then, of course, you know have to make sure that your financial situation remains organized. Got to keep your bookkeeping organized. It's just even more important with an S Corp election. You've got to keep your retirement up to date and make sure that the health and fringe benefits situation is taken care of. So there is, unfortunately, there's a lot of stuff to juggle when you have an S Corp. Oh, okay. So I believe this is another poll. And please, are you thinking about switching to an S Corp? Like, have you thought about it? Have you never heard of them before? Or are you still not sure after this presentation? Yeah, right. Okay. Let's see what the damage is. All right, most people are in. Over half of the attendees are in. So excellent. Well, if you're still not sure, then maybe we can change that by the end of the call. All right. Well, good news also. Collective is in all 50 states. When we first came on the scene, we were in a select amount of states, but now we're across the entire country. And kind of like I mentioned earlier, think of Collective as an all-in-one solution for your business. Your S Corp finances and administration are optimized and in one spot, in one company, and we take care of the whole shebang pretty much. And this is kind of what you can expect at your first year at Collective. For one, we'll set up the S Corp, obtain the LLC, make the S Corp election, get your EIN, and take care of all of that. Then we will handle the bookkeeping and accounting as well. Year-to-date bookkeeping, if need be. And if you're a current LLC, we'll actually clean up your books for the entirety of this year. And then, of course, just ongoing back office support. We do monthly bookkeeping, so you don't have to worry about it. And we send you the reports every month. Of course, we calculate your estimated taxes, which we just spent this entire webinar talking about. Like, we'll take care of that. And then we'll provide a salary recommendation, a reasonable compensation recommendation as well. And then, of course, you have a personal team that you can message at any time for questions or any guidance that you need. And then you've got, of course, the tax prep, which is your business tax prep for both the federal and the state. Okay, how much do you think Collective costs per month? I believe this is another, if I'm not mistaken, another poll question, unless I'm wrong. I could be wrong. I've been wrong before. Think I'm wrong. So it's $349 a month if you go the month-to-month route. And then, of course, when you first come on board, there is a one-time $199 onboarding fee. But keep in mind that that's all inclusive. And the $199 fee essentially covers all the setup that is involved when you come on board with the collective. It'll cover, of course, verifying that your entity is in good standing if you have one. We'll set up or transfer payroll if you have an existing S Corp or existing payroll accounts. And then, of course, we'll handle the employer registration and catch up and clean up your bookkeeping if you have an existing entity, regardless of how many transactions that you have. So that 199 is a pretty good deal, especially just for the cleanup bookkeeping alone. And then just a quick note is collective for a vast majority of our members pays for itself. With the S Corp savings that you have, we try our very hardest to only, sign people up and suggest the membership to people that are going to save money overall, even taking our fee into consideration. And of course, you can, keep in mind that your membership is tax deductible. All right. Well, here's the good news is that you can schedule a call with an advisor. If you are thinking about an S Corp, if you think collective, might be a good fit for you, then schedule a call with us and like we'd love to go through your situation. And let's say, and, no pressure, of course. Let's say that if you don't need to be an S Corp, if collective isn't the best fit for you, we'll also give you some referrals to some companies that could help you out. But we offer, a free consultation and a walkthrough before you sign up for services. And of course, now that you've watched this webinar, you do get a code. You get your first month half off. So, of course, jot that down. But you can also go to our website to schedule a call. It's usually pretty easy to do on the website. Okay, and now we have reached the Q&A section. So let's get started. I think that we are, and yes, so I missed the page with the pricing. Will you be sending this presentation at the end? Yes. So attendees will get or registrants will get a recorded version of this webinar sent 24 hours after. But I'll repeat it again and we can go through it again. And I believe we already have some questions. For some reason, it's not letting me open up my Q&A box. I see I have 4 questions here, but it's not letting me open up the box. And what I might have to do, so I have the person who's running this webinar, her name is Sarah. She's a great colleague and she's helping me out here. And Sarah, if you don't mind, if you can see the questions in the Q&A box, copy them in the chat box. Because for some reason, it's not letting me answer. It's not letting me see these questions for some reason. Or if anyone has it, okay, perfect. Here we go. Thank you, Sarah. Okay. And also, if anyone else has any additional questions, if you wouldn't mind, throw them in the chat box instead. For some reason, it's not giving me access to the Q&A box. Zoom sometimes doesn't like me very much. But, and Sarah also too, if you don't mind, keep an eye on the Q&A box and just copy these messages in here. But the first one is, how is pass-through money taxed? What rate is it taxed at versus wage tax rate? So, okay, that's a great question. So essentially, what the question is how are the distributions taxed? How are the business profits taxed? So like I mentioned earlier, self-employed people are generally dealing with 2 types of taxes. They're dealing with the income tax and they're dealing with the self-employment tax. The income tax is a marginal tax rate. The self-employment tax is a flat tax rate. And the entire point of the S Corp is to save on the self-employment tax. So before, like when you're an S Corp and you pay yourself a salary, the salary is subject to the income tax and the self-employment tax. But then you have your distributions, your pass-through profit, which I believe is what you're asking about. That chunk of money, it's no longer subject to the self-employment tax, but it's still subject to the income tax. You still pay that tax rate. That won't change very much from sole proprietorship, from LLC to S Corp. Your income taxes will essentially stay the same. So to answer your question, that pass-through profit, it's subject to the income tax typically. Is there a deadline for electing S Corp? Yes, there usually is. And if you have a current LLC, the deadline is usually March 15th of this year. So the deadline is technically passed for this year if you have a current LLC. But it's still possible to make a late S Corp election. And what we would do is include what's called a reasonable cause argument as to why it was late. And if you have those are typically accepted. So it's usually not a problem to make a late S Corp election. Oh, here's a good question. I operate as a sole proprietor. I invoice the companies for the hours that I work each month. Does that mean S Corp is not suitable for me? I think technically what I'm paid is what my salary should be since my invoices are based on worked hours. Well, you could still technically be an S Corp because technically your company is paying would now be paying your LLC, and you would be an employee for your own LLC S Corp. So they might be paying you for current hours that you're billing, but that doesn't necessarily mean that all of the money that you've made has to be considered reasonable compensation. It's still possible that you might be able to pay yourself a lower salary than what you make in total. So just because you bill hourly, that doesn't necessarily mean that you can't be an S corp. It's likely that you still could be one. If I already have an accountant, do you all work with them on the taxes together, or how do you interact with the personal tax accountants? That's a very good question. And what we'll do is we'll actually, after we file your S Corp tax return, which is due by March 15th of every year, by the way. But once we file that one, we'll give you what's called a K-1 form, and you would give that form to your accountant, who would then use that to file your personal return. Can you pay estimated quarterly tax payments without filing forms? You can do that online, actually. You can go to the IRS website and make online electronic payments. Does the LLC have to pay self-employment tax and income tax, or can they take distributions? Well, so it's not the LLC technically that's paying the self-employment tax and income tax, it's you. So the LLC isn't taking distributions, you are. My tax preparer says first quarter tax estimate is due April 30th, not the 15th. That could be correct. Um, I'll have to research that. That very well might have been incorrect on this form, so I apologize about that. But let me do some research on that, and I'll fix that if that's the case. Okay, and I believe that's all the questions that we have today. Well, I enjoyed it as I always do, and thank you guys so much for coming to this webinar. I hope I hope it was illuminating. And like I said, if you think that an S corp or collective could be a good fit for your business, schedule a call with us, and you can do that several ways. Like you can go to our website, collective.com, and schedule a call. You can do that here, with this QR code, of course. And be sure to bring this code with you to get a sweet discount. But also just a reminder that this presentation will also be sent out to you via email. So if you missed it, don't worry about it. And okay, I've got a couple more questions before I'm going to hop off. I don't mind to answer those. My income as an S corp last year was less than $50,000. Would it still be a good idea to be an S corp? Well, if you're already an S corp, and especially if you think that you're going to make more money next year, then yeah, you might want to consider staying in S corps, especially since you already are one. And on a current LLC, if you revoke an S corp election, you technically can't elect it again for another 5 years. So it's just there's several things you need to consider when deciding whether or not you should end your S corp election or not. Do I need to save receipts or statements? It's usually a good idea to save receipts and statements. And the typical advice is to save them for at least 7 years, which I know is a long time, but it's just a good idea, like in the event of audit or anything like that, to have as much substantiation as possible. All right, everybody. I believe that we got them answered. And again, this was so much fun. And I hope I see everyone at the next webinar.